Hello students, now let us start with the second part of valuation which we included in chapter 4. In this particular valuation, we are going to include the concepts like duration based valuation, relative price valuation and arbitrage price valuation. So, duration based valuation is also termed as modified valuation, because in this particular duration based valuation we have McCloy valuation method and modified valuation method, but we are basically talking about the modified valuation method. So, duration based valuation is an approach used to assess the bond's sensitivity to interest rate changes by calculating its duration. At what point of time the interest rate of the bond is going to affect its prices. So, duration is a measure that estimates how much price of a bond is expected to change in response to changes in the interest rate. It serves as approximate tool for understanding interest rate risk, which we have discussed earlier too, and the price volatility of the bond. Because of the interest rates, what is the effect on the price, and that is why we are calculating this duration based method. So, modified duration is widely used method for assessing how sensitive a bond's price is to the changes in the interest rate during the period for which the bond is issued in the market. So, modified duration adjusts the standard duration metric to reflect how much a bond's price will change for 1% change in the interest rate. It is calculated with the formula duration divided by 1 plus YTM divided by n. So, we know n number of periods. If it is a semi-annual, it becomes 2 and otherwise it is 1. So, in this particular example, the duration of bond is 4 years, it is already mentioned. If it is not mentioned, we have to calculate it. So, basically in all the bonds, the duration of bond is mentioned while the issuer is issuing. So, we have it. Then YTM is 5%. In the previous lecture, we have gone through that how to calculate the YTM. So, we can calculate it also. So, modified duration is 4 years divided by 1 plus 0.05, because it is YTM is 5 and we get 3.81 as a duration period, which is approximately measured in percentage. So, if there is 1% increase in bond price, the bond price will decrease by 3.71. So, we have mentioned in this particular concept that modified duration adjusts that standard duration metric to reflect how much the bond price will change for 1% change in the interest rate. So, here if there is an increase in bond interest rate, that is by 1%, the bond price will increase or decrease approximately by 3.81%. If there is an increase of 1%, there will be a decrease in bond price by 3.81%. So, if the bond price is 1000, we are going to decrease it by 38.10. So, it will drop to 961.90 if the rate increase by 1%. So, this way individual person or individual investor can calculate what is the effect of interest rate risk on the bond prices. What are the advantages of duration based valuation? First, it measures interest rate sensitivity. We are basically focusing with the help of this method that interest rate risk is a major issue for any sort of bond investor. So, if this particular sensitivity is there, we can calculate it and we can measure how much impact of that 1% increase or 1% decrease in interest rate and what will be the effect of price. So, if we increase the price, we know that if there is a increase in interest rate, there is the interest rate increases, the bond prices decreases. So, we are mainly concerned with this particular concept only. We are not focusing on what is the impact if interest rate decreases, because automatically the bond prices increases. But what is our major concern? What is the impact if interest rate increases, because it is going to decrease the bond prices, as I explained in my previous lecture also. So, first it tries to measure the sensitivity, useful for risk management, because with the help of this particular calculation or this particular valuation method, the investor can easily know how much risk exposure he or she have, and on the basis of that he can take care of that particular thing. So, modified duration is a key tool for portfolio managers to manage interest rate risk. By calculating the duration of portfolio, investors can make decisions about how to hedge or adjust position to minimize the interest rate risk. Applicable to wide range of bonds. So, this measure can be applied to most type of fixed income securities, including bonds with different coupon structures, maturities and credit qualities. It is flexible and useful for assessing interest rate risk. Basically, it can be applied to any type of bond and is easily applicable. Then next is clear and quantifiable metric. Modified duration provides us clear and simple explanation of how the interest rate is affecting the bond prices. So, it makes it easier to understand and take actionable decision at that point of time if it is affecting the position of the investor. And last, it helps in bond comparison. We can if the particular person, the portfolio manager or the fund manager or the investor has a number of bonds in his portfolio, he can compare it and select which particular bond is less risky or it has a less impact of interest rate risk on its performance. Now, coming to disadvantages, assume small changes in interest risk. It is typically focusing on 1% or less than 1%. So, every time there is an increase in interest rate, the bond investor has to calculate this and it becomes very tedious work for him. So, however, a large interest rate movement, the relationship between bond price and interest rate becomes non-linear and modified duration becomes less attractive at that particular point of time. So, if there are less or minute changes, it can be easily captured, but if there is large changes in interest rate, it becomes difficult to capture. Not suitable for bonds with embedded options because it becomes difficult to calculate, especially in case of callable and puttable bonds, because it may sometimes give inaccurate results, because in case of callable bonds the issuer may call the bond rates are decreasing because they have to pay less, and in puttable bonds if interest rate higher and there are options available to the purchaser or investor, they can go for it. So, it becomes less effective. Assume constant cash flow. Modified duration assume that bond cash flow or the coupon or the principal remain fixed, but it may not be the case. If there are changes in cash flow such as floating bond rates, modified duration may not be used. So, we can use it in case of fixed percentage bonds only. Ignores reinvestment risk because it is focusing on the interest rate risk and it is not focusing on the component of reinvestment risk. So, this valuation may be unfruitful for the investor. Then ignores non-interest rate risk while it is effectively measures the interest rate risk, but there are certain risk factors like credit risk, inflation expectation, liquidity risk that is basically ignored by this particular method. The next method, that is the fourth method, we have covered two methods in my previous lecture and this is the third which has explained duration based valuation, and fourth one is relative price method. So, in case of relative price method, we are not calculating anything, we are trying to identify the bonds which are of similar characteristics and what are their bond prices, and accordingly on that basis we are going to value our bond. So, this bond valuation technique is used to compare the prices of bonds with similar characteristics as I already mentioned. It is related to maturity period, coupon rates and credit quality to estimate the value of a given bond. So, if I have a bond value of suppose 1000 rupees and its characteristics are similar to other bonds that are available, on the basis of that I have to calculate the or on the basis of that I have to use a relative comparison and evaluate my bond price. This method is often used when detailed information or reliable inputs like future cash flows or accurate discount rate is not provided to the investor. It allows investor to estimate bond value by referring to the prices of comparable bonds in the market. So, how we going to do this? The calculation is very simple. First, try to find the comparable bonds on the basis of maturity, on the basis of coupon rate, on the basis of credit quality, that is the credit rating given by the credit rating agencies, and on the basis of liquidity. If the bond is easily tradable in the market or sellable in the market or not, what are the terms and conditions, on the basis of that we can see that. So, bond maturity should be same. If I am having a bond of 5 years maturity, I have to select a 5 years bond only. Coupon rate almost similar. Suppose my coupon rate is 5%, I have to select a particular bond which is similar to 5% or 5.5 or 4.75, relevant to that only. Credit quality, I have mentioned that similar credit rating should be given to that particular bond too. Then second, analyze the prices of the comparable bond. So, look at the market prices of these comparable bonds. If the bonds are traded on OTC or exchange, then it becomes easily availability of current prices we can easily get. Otherwise, it becomes very difficult to go for further calculation. So, if it is a tradable bond or we have it has a liquidity in the market, in that case, if it is listed in the exchange or it is traded in over the counter, we have the list of prices with us. Then adjust for the differences. If there are minute differences, we need to adjust it. How are we going to do this? If there are minor differences between the bonds, we are trying to value and compare the bonds. Slight differences in coupon rate or maturity should be estimated and adjusted accordingly. Suppose if the bond being valued has slightly higher coupon rate than the comparable bond, it may be valued higher. If a bond with a longer maturity might be slightly discounted compared to similar bond with a shorter maturity due to higher risk of interest rate changes. So, we have to check whether it has a long maturity period, what is the coupon rate, and how we going to adjust it. Then derive at the bond price, use the price of comparable bond as a reference point to estimate the price of the bond which you are valuing. The closer the bonds are in the terms of their features, the more accurate the estimate will be. So, in this example, we can see that we have a 10-year corporate bond, 5% coupon rate. What you need to find? You have to find two another bond. So, bond A is 10-year bond from a company with a credit rating offering a 5% coupon, currently trading at 1020. Another bond, that is 9-year bond with 5% coupon rate, similar company, trading at 1015. So, if we compare these two bonds, the estimate period is around 10 years, roughly between this to this particular band range. So, if bonds are highly similar, this gives a good approximation of what the bond worth in the market. So, on the basis of these two values, we can exactly evaluate our value might be equal to this particular bonds, because coupon rate is similar in both the bonds, time period is similar in case of our bond and A. So, we can assume that our bond will also having a value between 1015 to 1020. So, what are the advantages of relative bond? It quick and easy, because if we have a proper availability of data, we can easily compare the bonds and calculate it. Useful in less liquid market, because the bonds are frequently traded, it becomes difficult to get the prices because they are quite fluctuating in that situation. When the bonds are not frequently traded, we can easily get the data, and on the basis of that we can do the comparison. So, when bonds are infrequently traded or when detailed market data is not available, relative price method provides a way to value a bond on the available data for similar bonds, because in a case suppose our bond is not tradable, but other bonds are tradable, they have simple same proposition, we can use their data and go for this calculation. Practical for corporate and municipal bonds, because we can use this method easily. So, many corporate and municipal bonds are less liquid and harder to value using precise model like DCF or YTM. The relative price method is practical or alternative way to go for the valuation of bond. Disadvantages: inaccurate in unique or case of complex bonds. So, suppose there are certain unique bonds available in the market, in that case this particular method is not relevant. No insight into the intrinsic value, because we are not calculating any bond prices. So, we are in a position that we are not able to calculate the intrinsic value of the bond. Sensitive to market sentiment, the prices of comparable bonds can be influenced by the temporary market sentiment or liquidity factors, because we are talking about the or taking the bonds which are listed in the market and tradable and have a liquidity, but we are having a bond which is less liquid. So, in that situation, if the market is sensitive enough, then the fluctuation will goes on, and in this case we are getting less worthy results. Requires adequate market data. For this purpose, if we do not have any adequate data about the market bonds or the listed bonds or over the counter bonds, in that situation it becomes difficult to go for this particular valuation method. Next one is arbitrage free pricing approach. In this case, it is simply assumed that there is the bonds prices are almost equivalent and there is no chances of arbitrage in the market. So, this method is used to value bonds by ensuring that no possibility of riskless profit through arbitrage is possible. So, the central idea is that bond prices must be consistent with the prices of other bonds or instruments in the market, such that no arbitrage opportunities exist. So, in bond market, arbitrage free pricing approach is often applied by constructing a theoretical models, like in case of stock market or in case of financial theories which we have studied. This model assumes that bonds have each cash flow which is discounted at a rate consistent with the yield curve. So, this is the basic assumption of this particular approach. This method is used to ensure that bond prices reflect current market conditions such as interest rate and consistent and fair way. This method is more complex and it is basically used for mortgage backed securities or mortgage backed fixed income securities. So, this is less prevalent or less used by the investor because it is a complex method to calculate the bond. What are its characteristics or basic key concepts? The first one is no arbitrage. Arbitrage refers to the practice of exploiting price differences between the markets or securities to make a risk free profit. So, in this condition it is assumed that there no possibility of arbitrage is available in the market. So, in arbitrage free approach, the price of bond is set in such a way that it prevents arbitrage opportunities. So, no arbitrage is possible in the market, meaning no one can buy or sell related securities at different prices for a guaranteed profit. Then second characteristics, yield curve and spot rates. Here we have to rely on the yield curve, which is graphical presentation of interest rates for bonds of different maturities, but of similar risk. So, we have to identify the yield curve and then on the basis of that we have to go for the calculation. So, in this particular yield curve, what we are presenting the spot rates or the interest rate of the similar risk nature, and focusing that it should be presented in a proper graphical manner. So, each point on the yield curve gives the interest rate, that is the spot rate, that should be used to discount each future cash flow of the bond. So, the idea is that discount each cash flow at the specific spot rate corresponding to its maturity. This ensures that bond prices is consistent with the prevailing term structure of the interest rate. So, here we are focusing that our particular bond prices should be reflecting whatever the prevalent interest rate is going in the market. So, we are not focusing on the fixed interest rate, but here we are focusing mainly on the floating interest rate or the spot interest rate, and on the basis of that we are discounting our future cash flows and presenting it in a graphical format, that is in the yield curve. Next one is present value of cash flows. To determine the arbitrage free price of bond, each future cash flow, that is the coupon payments and the face value, is discounted using appropriate spot rate. As I mentioned in that in the previous concept also, that we are focusing on the current market prices or the current interest rate, and on the basis of that we are discounting our future cash flows. So, if the market rate is changing, the future cash flows also changes. So, this means that cash flow occurring sooner will be discounted at a shorter term rates, while the cash flow occurring later will be discounted at a longer term rates. So, According to situation, if suppose I am getting in 2 years period whatever the amount, second, or we can say the second year amount is based on the shorter period of interest rate. If we are talking about the 5th year coupon payments, we are getting a longer period interest rate. So, these are certain characteristics of arbitrage based valuation. Now, what are the advantages of arbitrage free approach? First, it prevents arbitrage opportunities. So, it is mentioned in the concept also that free arbitrage is not available in case of this particular bonds, or if we are using this particular bond valuation technique. So, this method ensures that no pricing discrepancy that could lead to arbitrage help to keep bond prices in line with market expectation. So, there is no discrepancy happening in the market because we are focusing on the spot rates. Next, the more accurate than single discount rate method. By discounting each cash flow at specific rate that reflects the current yield, because we are focusing on the spot rates, the arbitrage free pricing method provides more accurate valuation to the investors. While in case of single discount rate, we are focusing on only one, or we can say the in case of fixed rate, we are focusing on one particular interest and we are calculating or doing the calculation. It may be a wrong, or the prediction may be wrong, but in this case the prediction is accurate because we are focusing on the market interest rate. Reflects current market condition, whatever is a market condition, it is reflect on the interest rate, and we are using this approach to form our yield curve. Applicable to complex bonds like embedded bonds, we can use this approach, that is not possible in case of simple bonds. In case of other particular techniques also, we have learned that these particular DCF or yield to maturity or relative pricing we cannot use for more complex bonds, but this arbitrage free valuation method we can use for complex bonds with the help of binomial trees and Monte Carlo simulations. What are the disadvantages of this particular approach? First one, it requires detailed market data. If we have the detailed market data, only based upon that we can go for the calculation of yield curve or discounted cash flows. But if we do not have the market data, in that scenario we cannot use this particular technique. So, to apply this method accurately, you need access to full yield curve or spot rate curve, which may not always be readily available or easy to estimate, especially in less liquid market. And again, it becomes very important that every type of investor cannot go for this calculation. It is very tricky and difficult calculation. So, normal investor cannot use this technique. Assumes no arbitrage exists, that is a major assumption of this method. While this method aims to prevent arbitrage, markets are not always perfectly efficient. The temporary pricing discrepancies may still exist. So, they said that there are no arbitrage in the market, and because of no arbitrage there is no discrepancy, or vice versa, because of no discrepancy no arbitrage is possible, but in reality discrepancies exist, and because of that the prices may fluctuate. Complexity, it is more complicated valuation method. For bonds with more complicated cash flow structures, example floating rate bonds or bonds with embedded options, the calculation can become more complex, requiring sophisticated models and computational methods. So, in previous point we have mentioned that in case of embedded options or complex bond, we need Monte Carlo simulation so that we can use this technique. So, these are certain techniques on the basis of which we are calculating or we are doing the bond valuation. So, I have gone in the previous two lectures, or we can say the third lecture and fourth lecture, we are focused on the valuation techniques. These valuation techniques include DCF, that is discounted cash flow. Second one, we talk about yield to maturity, how to calculate it. Next is the duration based or modified duration based, then we talk about the relative approach, and finally we talk about the arbitrage free valuation method. So, all the valuation methods have their own advantages and disadvantages. Based on the knowledge of the investor, they can use it, but since there are changes in the market scenarios and changes in the techniques that has been used with the advanced computers, investors can also use the advanced techniques. But for more for investors, DCF and yield to maturity are more relevant one. For fund managers, they can go for arbitrage fee valuation, or they can use duration based valuation, because it is more accurate calculation method and it is going to be used for various types of bond. So, with this we come to end of this particular lecture. Thank you.